Well, fantastic. Ladies and gentlemen, welcome back. While people are coming back in from the coffee break, before we get started on the next panel, I'd just like to mention that this evening from 4:40, we'll be having some drinks and canapes just outside here in the lobby, in the foyer. So please do join us for those. For a bit of extra networking at the end of the day. But now we are going to have a discussion about the US style shell revolution. Can it be recreated anywhere else in the world? And we have a fantastic group of experts here to talk about this. On my immediate left here, we have Philippe Cohen, who is CFO at African Excellence Investments. Philippe has a number of other hats. I'll get the panelists to introduce themselves in just a little bit, but Philippe, welcome to you. We have Christophe Barrett, who is a senior oil analyst at the International Energy Agency. Many of you will have seen his fantastic presentation, which kicked off the conference this morning. Gave some very sort of, I think, cautiously optimistic outlook for the market. So, Christophe, welcome. We have Jenny Wong, who looks after the oil and gas investments for APAC Resources, which is a listed fund here in Hong Kong, and Kunal Agrawal, who's a senior energy analyst with Bloomberg Intelligence. So, panelists, welcome. Thank you very much for coming today. To start things off, I think it'd be interesting just if everyone could give a brief sort of intro to who they are, what they do, and where the US where shale exploitation fits within their sort of portfolio. So, Philippe.
Absolutely. I'm a consultant in the natural resources sector for a number of companies. I have a particular interest in the shale operation because I have one of my bases in Houston where I used to work for Paribas many years ago. And that's my interest in seeing where else it can be applicable, and we'll talk about it very shortly.
Where are you based, Philippe?
I'm based out of Geneva, of all places.
Fantastic, fantastic. And Christophe.
Yeah, hi, Christophe Barret. I work for the IEA. I am in short-term, in the group of the IEA that does short-term and medium-term forecast. So, of course, we look at shale oil development, and the particular interest we have in shale oil, of course, it's a way it has transformed the market and transformed the way prices are formed, and the possible impact it may have on trade flows in the next quarters.
Fantastic. And Jenny.
Hi, I'm Jenny Wong from APAC Resources. APAC Resources is a long-only global resources fund, so metals and mining and oil and gas. I look after the oil and gas investments, and I guess in terms of the US shale, it's a huge market for us in terms of investment universe, and so it's obviously a big impact for my portfolio. Thank you.
How many companies do you invest in the US?
In a portfolio of maybe kind of 20 to 30 stocks at any given time, we might have somewhere 10 to 15 that are in either US or Canadian shale.
Right, so significant part, yeah, absolutely. And Kunal.
Hi, I'm Kunal Agrawal. I work with Bloomberg Intelligence. I'm based out of Hong Kong, and I've been here for about 2 years in Bloomberg. I was with BNP Paribas for about 8 years before. So I've been covering, I've been a commodity research analyst for the last 10, 12 years, looking at energies in particular right now, but in my past career, I've been looking at energy as well as metal and mining stocks. And what we do essentially, we not only look at the sector overall, but we also look at the companies and try to advise smart money managers here like Jenny to make investment calls, investment decisions in equities around the world. Shale, it's important to us because we've been discussing since morning, the amount of shale oil getting produced from the US is not only disrupting the global oil supply balance, it's also impacting prices, which eventually affects the entire value chain in the industry. So while we are not actively covering the US sitting out of Hong Kong, but we keep monitoring that all the time.
Fantastic. Well, let's start off by talking about what is the state of play, US shale. How's the sector looking, and what is the impact that it is going to have or is having on global markets? Kunal, do you want to start us off by this? The state of play. How's it looking?
I think production from the US is looking fantastic. It has been growing multifold over the last couple of years, and we don't see any reason why that should stop, at least for the time being, especially with oil prices hovering around $70 plus. WTI, the benchmark for the US company, is slightly lower, mid 60s, but it's still a very healthy price. Importantly, what we've seen, the struggles for shale in the earlier years was the break-even prices for shale fields were pretty high. They were over $80 a barrel, and back in 2014, before 2014, oil prices were 100, and they got a boost, and suddenly production fell when oil prices went down to 30, 35 in 2016. Now, what has happened over the last couple of years is that the break-even cost of fields across the US shale basins have dropped dramatically. And what we see is the average break-even cost across all basins. There could be variances up and below, but is about $40 a barrel, less than $40 a barrel. So at $40 a barrel oil price, almost 90% of the US shale field actually break even. At $65, they don't not only break even, and they have money for more investments, paying off their finances and debt, and and continue to grow in the future as well. So it's looking pretty good and rosy, or at least for the next few years. If oil prices remain where they are, looks fantastic.
What has enabled the cost of production to fall so dramatically down to $40 a barrel?
I think a couple of things, but one thing that really changed a lot of things was there was a lot of M&A that happened in the shale fields basins in the US the last few years. So essentially, shale is basically hydraulic horizontal drilling. So you go deep down and then spread it out horizontally across the area. Initially, the basin, the land acreage per energy company was pretty small. So even if you're drilling a well and you're going horizontal, you basically reach a vertical wall beneath the ground, because beyond that is somebody else's acreage. But if you guys merge together, if the companies merge together, then you can drill that same hole much longer inside, and that generates economies of scale. So while on an average, if you look at 2014, our numbers kind of put out that the average productivity per rig in the US was around 230 barrels per day per rig in 2014. That has gone up to almost 600 barrels per day per rig right now. So almost a threefold increase in productivity from the single field, and that automatically reduced the cost, besides other things, from $80-ish to about $40-ish right now.
Fantastic. And Jenny, your companies that you invest in the US, how have they performed? How do you see the sector sort of evolving?
Sure. Without a doubt, production's continuing to grow in the US. I think, as Kunal mentioned, the M&A has enabled high-quality E&Ps to kind of block out their acreage, which allows them to be efficient in terms of development. That includes things like longer laterals, but also pad drilling, all those things that brings costs down. Obviously, it's helped from a services side that inflation hasn't happened in the last few years, and it's actually been deflation. Costs have gone down. Obviously, we're at a point where that looks like it might be inflecting, but nonetheless, I think these companies now have the good E&Ps now have great acreage, well blocked out in good areas, and they've also become a lot more disciplined in terms of cost cutting, and so as a result, their break-evens have gone down on a corporate level as well, not just from geological benefits or kind of drilling benefits and services, but also just a focus on costs. Similar to what we've seen in the mining sector, they probably did that kind of 3 or 4 years before the oil and gas sector had to, and that cost cutting seems to have been sustainable. Obviously, there's going to be some creep at some point in time, but we're not there yet, I don't think.
But with the oil price going up, is cost inflation
Yes.
a real risk? I mean, and I think maybe in the mining industry, which you touched upon just now, probably nobody saw it coming right up until the moment that truck drivers were being paid sort of $200,000 a year. Are you going to see a similar sort of boom in costs in the oil and gas
To be
sector?
honest, I think we're already seeing that. If you're looking at Permian, trucking costs are very high. It's very tight right now. the smart operators are having to move away from trucking to move product or sand or water or all those kind of things. And so there's no doubt that E&Ps are definitely talking about 10-15% increase in costs year on year. They talked about that last year, and it was probably a little bit higher than 10%. It's probably going to be 10 to 15%, maybe a bit more this year, depending on where the oil price goes. So I think, yes, services comes hand in hand. Costs will creep up a little bit, but I think that the memory of the last few years with the weaker oil price is still fresh in people's minds. So everyone's a little bit cautious about pushing too hard. Companies are also not investing for growth, or apparently they're not anyway, depending on what they're telling investors. But at the moment, investors have told them that they want to see kind of value, shareholder returns, and you're seeing that being reflected in strategies. And so some companies are growing within cash flow, some are not even using up all their cash flow, they're returning some of that to shareholders, and there's only kind of small caps that are still trying to grow outside of cash flow. So there is a measure of discipline. How long that lasts is, I think, a function of oil prices and how high oil prices get. But as a US swing producer, I would expect that to kind of it would influence itself. So I think it'd be okay.
But in terms of and how are people performing in terms of oil field depletion? I mean, there's been some talk recently about maybe some of the sweet spots are not as sweet, as big as possibly first thought. What's your take on that?
I think that has yet to be played out. So I think there's obviously, as I mentioned, I think some of the large E&Ps have done very well, pegged the sweet spots, and they have a lot of running room ahead of them. However, Centennial Resources is run by a man called Mark Papper. He used to be the CEO of EOG, which is one of the large Permian players. His kind of recent run around in terms of conferences and presenting is that the sweet spots in the US are not as extensive, and so the growth projections for US production are not going to hold up. That's kind of his thesis. I think it's too early to know for sure where we're going to sit. No doubt there's going to be a kind of restriction on what sweet spots are, but for the next kind of 12 to 18 to 24 months, what I would call the short and maybe slightly medium term, that's kind of not going to be an issue. But whether that plays out over the next 5 years, it's hard to say. But it's definitely something that at least someone like Mark Papper is going around talking about, and he's probably talking his own book, being a small producer and wanting the oil price to be strong. But nonetheless, I think it's just an interesting perspective, and I guess we'll see how US production plays out. But it's something that's probably kind of more a 4 or 5 year horizon.
And let's talk a little bit about the impact that US production is having on global production supply. So, Philippe, do you want to?
Okay, sure. Yeah, to put things in maybe a little bit more global perspective, what we expect for 2018 is a growth in shale oil production of roughly 1.3, 1.5 million barrels per day. So it's a huge increase, and that is to compare with a similar increase in demand. So most of the demand increase could be covered by the increase that we have in US shale oil production. And that should continue in the medium term, because when you look at the forecast that we had this morning, basically we expect a little bit more than 5 million barrels per day of non-OPEC production to come on stream by 2023, and of these 5 million barrels per day, 3.5 would come from the US. So it's a major source of additional supply, and it is basically the source of supply that will be coming on stream in the short term and medium term. But what is maybe more remarkable for us, it's a reaction of this supply to prices. When you look at the recent data, at what happened after 2014, 15, 16, basically, we have a drop in US shale oil production because of very low prices. And when prices started to come back to more average levels, then the production restarted very fast. The latest data that we have are showing a very strong increase in US shale oil production in the last few months. So this is kind of new to the market, because we are moving from an environment where basically you had OPEC, non-OPEC, and the demand, and the adjustment between supply and demand was mainly ensured by OPEC, that was adjusting its supply to the demand, given the non-OPEC production that was pretty rigid, pretty fixed. Now we have a non-OPEC production that is pretty flexible and that reacts to prices. So it means that the adjustment of the market has moved from being in the hand of OPEC to being insured by prices. So we are moving to a real market environment where prices should adjust supply-demand thanks to the shale oil reaction to prices, and of course thanks to the demand reaction to prices too.
What do you think this is going to do to the future kind of highs and lows in the oil cycle? So is it going to flatten things out, or is it going to exacerbate?
As you say, well, intuitively, I would think that there will be some cycles because you'll have if prices go to a level that supports a strong increase in US shale oil production, you have some lags, of course, between prices and the production, and maybe 3 to 6 months. And then you have additional shale oil production. So we have the risk of having strong prices, implying a strong increase in US shale oil, then of course market imbalances and a drop in prices, reduction in shale oil, and then etc. So that should be a little bit more cyclical than what we have had. But on the other hand, you should not see the very high level of prices that we had in the past, because there is no reason for that. I think that, again, in the kind of old world, when you had imbalances between total supply and demand, prices had to increase to a certain level just to destroy demand in order to rebalance the market. But right now, it's no longer the case, because if prices start to increase, then you have shale oil production that will follow, and therefore we don't have to go as far as we had in the past. So I think that you should have a kind of cyclical prices, but with a lower high and lower lows.
Smoothing it out.
Yeah.
Philippe, what's your take on?
I would say that there's three things that are changing the patterns of the flows that we see in the oil markets. As my colleagues have said, the current oil shale producers are making more money than they have ever made. America is becoming a first class exporter. You are having major exports towards Europe. There's even been, I'm told, a cargo gone to Abu Dhabi or the Emirates very recently, which is kind of a very amusing factor when you think about it, exporting crude oil from America to the Emirates. And it's reflowing all the West African crudes, which used to go a bit to the States, a bit to Europe. It's now all going to the Far East. So it's completely changing the flow, the logistics, the fact that there's such a differential between Brent and US prices, also going to probably have other effects, because now it makes sense to take crude to Europe because it's cheaper than Brent. Will it affect crude prices in West Africa going to the Far East? I think it has already done that, but it can also be a stabilizing factor for the price of oil.
Absolutely. Well, I mean, it sounds it's in a very positive state at the moment, the US shale production. Can that be replicated anywhere else in the world? That is really the sort of main topic that we want to discuss here. So starting off maybe with China, obviously, geologically, it seems that China has a lot of potential for shale production. So what's stopping China, or can China replicate the US-style shale revolution? Jenny, do you want to kick us off with that?
Sure. I guess with China, most undoubtedly, shale gas has been taking off. Sinopec and PetroChina are the main producers in the shale industry in China. To date, it has been SOE driven, I guess partly because the economics have taken time to develop. So a few years ago, you saw some of the independent service providers like Anton Oil form JVs with Schlumberger, Halliburton, to kind of get some knowledge there. The in-house providers for services, so the Sinopec and PetroChina in-house guys weren't quite ready yet. That's all kind of improved now, and I think services, both in-house and independent, are now able to do what is required for shale gas. I'm not saying that they are as technologically advanced as they are in the US, but nonetheless they can do what needs to be done. Hydraulic horizontal wells, fracking, all of that is okay. And so the production is definitely coming online. Sinopec is probably at this point break even at the kind of Chinese gas price. They get shale gas gets a subsidy in in China of about $1 an MCF above the average price of, let's say, around $6.50, and so they break even around about $6.50 and making a little bit of money. But they have a mandate to grow shale gas production. China has a 13th five-year plan that has an aggressive growth strategy that shows shale gas should triple, but I don't think they're going to meet that time frame, but nonetheless it's still a mandate to grow. PetroChina is probably break even with the subsidy and presumably will improve. So the economics aren't as compelling as they are in the US, but the point is that the US has a much lower gas price. Henry Hub's now $2.75, possibly going lower depending on who you speak to. Whereas the gas price in China looks fairly stable. China probably doesn't want it to go up too much because they're trying to encourage demand for gas and switching from kind of diesel and other fuel sources, coal, and moving into gas. So they don't want the gas price to increase too much. But similarly, it probably won't go down too much just because the kind of competing sources of gas, pipeline and LNG, are still quite high. And so, PetroChina's been doing what I would call national service for the last few years and taking a loss on their LNG imports. So that's probably, the $6.50 is probably a sweet spot for the time being. I'd expect to see shale gas production continue to grow, mainly from the SOEs, not really outside of that.
And there are some incentives for China as well on there to grow their oil and gas production in the centre of China to move away from relying on imports to the coast.
Well, I guess when we talk about gas imports, I mean, the demand centres for gas are actually in the population centres. So LNG is okay in that it's on the coast, but I guess the main issue is that it's just expensive, and so like China wants to diversify. They don't want to be fully reliant on LNG imports or pipeline imports, and so I think they will continue to develop their own homegrown shale gas opportunity, and I think those costs will continue to come down, as we've seen them come down in the US and in Canada and actually in kind of all shale basins and all oil and gas kind of producing areas.
But geologically, how does it differ from the US?
In terms of I think that there are several challenges in China, and I'm sure my colleagues or my panelists will speak on that, but I guess topography is a big thing in China. Sichuan Basin is quite mountainous, so it's not easy to develop. Infrastructure is not as well developed as it is in the US, and so you have to build pipelines out and that's an extra cost. And then access to water is not always as easy as it is in the US. Not saying that Texas is got lots of water, but to date it's been okay. That might be a constraint going forward, but for so far in the last kind of 10 years since we've seen the kind of shale revolution start, there's been kind of sufficient access, whereas it's not always the case in China. And then also the main thing is that the US has kind of individual private landowner rights, and the landowner kind of also owns rights to the oil and gas, and so they're incentivized to develop it. That's not the case in China. It's the oil and gas rights are owned by the government and need to be bid from, which is kind of the case everywhere else or most places.
That's right. Kunal, your thoughts?
I mean, just to add on to Jenny's points here, so when you look at the overall cost for shale fields, I think there are two aspects of it. One is obviously the drilling costs, drilling and completion costs, and the other part is the infrastructure cost in terms of hauling in all the raw materials, sand, water, chemicals, and hauling out the eventual final product, natural gas, so trucking and pipelines. That itself remains a challenge. Like Jenny mentioned, it's mountainous, so getting infrastructure in place is more difficult. Water is scarce. But when we focus on the drilling cost itself, I think that's one place where China has made a lot of advancements over the last couple of years. So if you look at the US, typically a shale field in the US costs around $6.5 million for drilling, completion, cementing, everything putting together, an all-in cost of about $6.5 million. Recently, 4 wells in Sichuan basically were drilled and completed for $7.5 million. So the gap between the overall cost for drilling a well in the U.S. and China is kind of is narrowing. The logistical cost obviously remains high, and that is something that needs to be addressed over the next few years. But there has been advancement in terms of cost reductions, and we'll see how that goes over the next few years.
So obviously the SOEs are leading the charge in China. What are the opportunities for private companies to develop projects there?
I haven't seen much, to be honest. I assume it's because it hasn't been very economical. It's hard to get the economies of scale to get it to make sense. You have Sinopec and PetroChina kind of dominating it at the moment. They also have the right acreage, and China's actually, the shale is less contiguous than it is in the US. Based on my very, very limited geological knowledge, there's just been more tectonic activity, and so the shale is not as contiguous, and so there are very clear sweet spots in China, and I think they're being developed by Sinopec and PetroChina right now. So I don't really hear much about independents getting into the shale space. I think it will be probably a few years before we hear a bit more about that.
I would agree with Jenny here. I mean, if you look at broaden the horizon, look beyond China and overall Asia Pacific, you would see most of the energy companies here are typically SOEs, state-owned enterprises, and not a lot of independent players actually operating in the exploration business. I mean, typically you need certain metrics for people to come in. Basically, you have to have stable fiscal regimes. Pricing policies should be very clear. Land acquisition should be easier, and all infrastructure overall should be pretty healthy. And that is where US kind of stands out. It's a very independent market. If you look at China or India or any other market, first of all, gas price, city gate prices are regulated. That means that it's not a market-driven price. So your end price product is actually fixed. You have to work back towards your cost. So that kind of is a hindrance for a lot of players. And then obviously getting land itself, ownership for land can become quite tricky in a lot of geographies in Asia.
Let's talk a little bit about Australia. Obviously, it's the home of many junior natural resources companies, private companies. They've got, rule of law, stable government, all this sort of stuff. How's Australia doing in terms of recreating the US?
Well, environmental concerns in Australia have been more talked about than probably been talked about in China, for example. I mean, the government tends to listen to all those concerns and tries to act on it. What recently happened actually probably is a very positive thing for the shale industry. Northern Territories actually lifted the fracking ban or the moratorium on fracking that was there in place for the last 2 years, and that might encourage other territories in Australia to follow suit and probably lift the fracking ban there. That could drive a lot of more investments coming into shale fields in Australia. It has one of the largest reserves of shale gas globally. So no reason why, besides, like you said, besides the environmental concerns, everything else can fit into place for Australia. So that is one thing that we see positive signs. So very recently, fracking ban has been lifted. Let's see how that goes.
Are any of the other governments looking at lifting the fracking ban or considering it, or what is the state in Queensland and New South Wales and WA?
Well, I mean, so even Northern Territories, they lifted the fracking ban, but said that 50% of the land area would not be fracked upon. This includes the national parks, where people live, or where industries are situated. So all those are off limits, and I think it would be like let's see how it pans out in Northern Territories, and then see how the other regions to react to it. So I wouldn't expect them to follow suit immediately. Probably 1 year, 2 year down the line. There are a lot of companies who are willing to start drilling test wells already the moment there's a good to go from the government. I mean, they are finalizing the draft resolution in terms of what can be done and what cannot be done in Northern Territories. Once that draft is out or those rules are out, probably you'll see investing activity coming back. And then probably 12 months to 2 years down the line, you could see other regions reacting to it.
Argentina has been mentioned as a possible destination. Anyone care to give some thoughts on that? Philippe?
Yes, I mean, in everything we've talked about gas effectively, because outside of the US, there's not that much potential for shale oil, sorry. Argentina has potential. It's a country that has always been very difficult to operate in terms of approvals. The provinces have huge rights, and each province operates differently. So some provinces are impossible to deal in, others are not. And it needs a stable government. I mean, Argentina, from my experience, is a bit like Russia. When there's something really good, somebody's going to take it from you. Repsol's gone through that. And the oil and gas, the mining, and the telecoms industry have gone through that before. So is Mr. Macri going to stay in power long enough to make it a stable country is also a good question. If you want, I can also say a couple of words about Europe.
Please.
Europe has potential in countries on the gas side as well, in countries like Poland and Romania. And then there are other countries that are going for environmental bans, like France, like Germany, where nothing will happen. I'll leave the case of the UK for your panel tomorrow.
Tomorrow, yeah.
And there again, it's often in populated zones and not so easy to get around. A bit like what you were saying about the northern, parts of the northern territories, reserves, and special sites. I mean, for instance, in Poland, one of the big gas reserves is under the third town in the country. So it's a bit like looking for oil under Gatwick.
What is the public reaction towards fracking in Poland and Romania? I know in Romania, obviously, one of the big gold projects was put on hold.
Yeah, yes. I mean, it's not very politically popular. I don't think much is going to happen in Romania. Poland is a bit different because it's run by a sort of revisionist right-wing government, so anything can happen. We've seen it in the US and in other countries, but it will be for domestic use. It will not be, or maybe export to Germany. It's not going to be much of a market. The same way we're saying, what about the oil, the shale? Potential bringing to, for instance, LNG to China. That will continue to come from Southeast Asia and the Middle East because there's not one terminal that is planned on the west coast of America for liquefaction of the gas and transport. I mean, there's 3 in British Columbia that are in the works, and absolutely none in California, which was the first country to look at it, the first state to look at it, even before Texas. So nothing's going to come from there. It's all going to be, Indian Ocean to Pacific.
Sounds in many of these countries, the key challenge really is the regulatory public perception side of things rather than the geological and technological challenges. How important do you think is the need for countries to sort of correctly align the incentives so that, I mean, for example, in the US, land ownership rules means that, if you have some farmland with some shale underneath it, someone can come up to you and say, do you want me to drill on your land? Here's some money. Whereas that might be different in other countries. How important is for the government to try and realign those incentives, or how easy is that to do? Is it possible?
I think it's been a classic conflict forever, right? Whether you pick up mining or energy, it's been a classic conflict forever. And obviously, I mean, the government has to look into other things, not just the monetary aspect of it or the financial aspect of it, but also when it comes to fracking, it's about the environmental concerns. So, I mean, there's been a lot of talk about fracking pollutes the underground water tables. That basically could lead to health concerns for the people involved there. So the government has to be aware of that and take that into cognizance before approving deals or approving projects. And then ownership is the other part of it. Ownership could mean a lot of things, whether it's probably ownership of the land or probably in a lot of places you see employment being generated. In a way, you can actually work in those fields, or you could actually work as a contractor there, or so there are various ways basically you could address the issue.
Do the companies also just need to be more proactive in educating the public about what they're doing, being more maybe transparent in what's in the fracking fluids and things like this? Do the companies need to step up and do more PR?
I think if an oil and gas company is doing PR but they're still drilling near population centres, that's not going to work either way. I think in the US there's obviously areas that have been very well developed for oil and gas historically, and so it's kind of been accepted. Texas being kind of a prime example of that. And so I think it's much easier for companies to target those kind of areas. And the fact that there has been industry there before and reservoirs there before would suggest that underneath that there's a kitchen, which is where the shale is sitting, and that there's shale potential where there has been kind of oil and gas conventional development beforehand. So I think that kind of helps a little bit. And I think actually the incentive has to come from governments more than kind of E&Ps trying to do some PR there. I think they just have to accept that population centres are not going to work. If you look at kind of governments, I mean, they might not have the US rights, but like I mentioned before, China's giving a subsidy to shale gas. It's the same thing in Argentina. I believe in 2018 the gas price for shale production is $7.50, which is nearly double the spot price in Argentina. That will ramp down over time, presumably as economics improve. But that's an example of what governments do at this point in time to incentivize shale.
Yeah, it would require major lobbying by the oil companies and working together, which is not something they do that often. And the other point, you made a point on water. One is the effect that it's potentially polluting the water. The other is access to water, which is not available everywhere to do all this gas fracking. And I think Jenny can tell a bit more about what the situation is in central, southwest China. In that aspect, aside from what you mentioned about Sichuan and its mountains, but access to water is important. I don't know how much water there is in northern territories, for instance, for that sort of activity.
I think water plays a critical role, especially in shale fields, because you need about roughly 2 barrels of water to get out 1 barrel of oil equivalent gas. So you need double the amount of water to get one unit of gas out. So, and importantly, the water has to be fresh water. It cannot be seawater. I mean, you have so many shale fields near the coastal regions, but you still need to bring in fresh water because seawater, the salt and the chemicals in the seawater reacts with the chemicals that you put in the fracking, and it kind of clogs the holes in the wells, and it can just you would not have any gas coming out. So, and fresh water then again obviously competes with the population needs, the industry needs, the farm needs, and when you have lack of water, like China, Jenny can talk about. India, for example, I can talk about is that India is agrarian economy, which relies on rainfall, monsoon, to develop most of the farms. So you cannot really use fresh water to go out drilling for shale fields there. It becomes a huge challenge, a socio-economic challenge.
Or it could become a seasonal business.
Well, that would probably not justify the economics of the business at all.
And would also pitch the farm lobby against the oil and gas lobby, and the farm lobbies are usually pretty strong. Do we have any questions from the audience for our panel here? We have a hand up over here. If we get a microphone.
Michael Jones from Fortune Oil. One of the panelists made a comment about US shale that making more money than ever. I think since 2010, the US shale companies have spent 260 odd billion more than they've actually made. To say that they're making more money, are they actually turning a profit? And the other point is, we're moving now. The Fed's going to push up interest rates. How's that going to affect the sort of, the growth in going forward for the US shale developers? Since 2010, interest rates have been zero. They're going to go up 4 or 5 times this year.
Well, it's definitely going to affect the cost of production, which we've talked briefly about. Yeah, I agree with you. And I mean, they are finally making money. I think it's yeah.
Well, I think
at the moment, they're making profits at the moment.
Yeah.
Last 3-6 months, which
I
is
would
unusual.
say that they're making free cash flow, which is not necessarily profit if you're taking DD&A into account, but at the moment I'd kind of also argue the investment community isn't really looking at profit as an NPAT kind of a line. It's really, wanting to see cash flow and an ability to return that to shareholders. And so from that perspective, I would argue that they are making money for the first time in quite a while. And it's obviously been kind of this last kind of 3 to 6 months with the boost in the oil price rather than kind of any spectacular change elsewhere.
I think, like I also mentioned, the overall cost, the break-even cost for these companies have come down drastically over the last couple of years, from about 80 odd average to about $40 average right now. And you are looking at oil prices, WTI at around 65. So you're about $25 plus in terms of just break-even price. Now, I think interest costs are probably, it's important, but I think it's been over-talked about. You borrow $100, you're probably paying interest of $1 earlier on, and you'll be paying interest of $3 now. So probably the interest rate has gone up 3 times, but from $1 to $3. Oil break-even cost has gone down from $80 to $40. So the spread there is $40 versus a spread of $2 extra here. So yes, it's important, but at the same time, if you look at the overall scheme of things, I don't think that would probably be a huge hindrance for generating, for raising capital or being able to service capital, at least in the near term, if oil prices remain where they are.
I would just add to that, just on the interest, no doubt that that's going to be a cost. Most of the kind of small mid-cap companies that are very highly leveraged, they trade at a discount to their peer group because of concerns like what you voiced. So I don't think that that's a non-issue. But, as my colleagues have said, there are other factors that have helped in the near term. But that is undoubtedly a headwind, perhaps not as big as it might have been when oil was $40.
Question?
Brian Anderson. Just a question which is out of the ballpark a bit, but there's a lot of risk, in my opinion, what I hear from people who seem to know, of economic instability in the next few years. I've seen scenarios that are really bad, and I've seen ones that are just pretty awful, and some which are okay. I'd like to ask Christophe, do you factor into your forecasting the upsets and uncertainties that might occur? I know that you don't publicize it, but do you do that? What are the downside risks here is what I'm asking.
Yeah, well, in our forecast, what we take, it's standard scenarios, and right now, what we are taking, it's OECD scenarios for the OECD countries and IMF for the rest of the world. And when you look at that, it's very strong. You have a strong momentum in economic growth. You have very strong growth in 2018, 2019, same growth. So basically, from the economic standpoint, it seems to be very, very optimistic. However, there is a risk, clear risk of, as I was mentioning a little bit this morning, there is a risk of a trade war that would impact a lot oil demand. It would impact oil demand because it would directly impact bunker fuel demand, 3.5 million barrels per day. It would impact a lot diesel demand because a lot of goods that are imported in the US, for example, on the West Coast, are moved through the country by trucks, and that there is a good correlation between diesel demand in the US and the arrival of containers at the port of Los Angeles. So that's a big impact big direct impact, and that would have a strong impact too on the exchange of petrochemical product. When you look at what China has replied to the US, look at the product that China wanted to tax after the US move to more protectionist measures. The petrochemical products are the first taxed. It's ethylene, it will be LPG, etc. And if you look at the energy demand right now in the US and in the forecast that we can have for 2018 and 19, a large part of the demand will come actually from petrochemical demand. A large part of that will be ethane that is captured out of shale gas, and that is now sold to petrochemical projects. Those petrochemical projects, to be implemented or to survive, they need to be able to export. And the main market for the export of petrochemical product in the next 3 to 5 years will be obviously China. If China cuts the possibility of exporting product for the petrochemical producers in the US, they may be put in difficulties, and that would have strong impact on oil demand. So yeah, there is a risk for oil demand. Right now, the main risk that we are seeing would come from a slowdown in trade, but of course there are other possible risks. We cannot factor that in the main scenario, but obviously we have to take that into account. And then if you look at the current conditions compared to the condition we had when we did the medium-term forecast or even a short-term last month, you have had since then a very strong increase in prices. And this increase in prices will have an impact on oil demand. There is a relatively moderate but existing price elasticity of oil demand, and the higher goes the price, the higher is the elasticity. So what we can see right now with a strong increase in prices and the possibility of a slowdown in economic activity and in particular in trade, there is obviously a downward risk to the forecast, but that we'll have to wait and see how things develop before putting that in the forecast.
Okay. Thank you very much for that. We've unfortunately run out of time. I'm sure there's lots more we could ask our panel, but a very interesting discussion there. A very good outlook for US shale and possibly some opportunities in other countries, ones to watch. If we can have a big round of applause for our panelists, please. Thank you.